England's most ambitious financial scheme promised unimaginable wealth. It delivered only ruin. For some, the silence isn't quiet. It's the distant echo of a nation's shattered dreams. In the early 18th century, England was on the cusp of a financial revolution, yet utterly unprepared for its darker side. The South Sea Company, born from a seemingly brilliant solution to national debt, instead birthed a speculative frenzy that would cripple thousands and redefine the very meaning of financial collapse. The year is 1711. Great Britain finds itself burdened by a substantial national debt, a legacy of costly wars. Enter Robert Harley, Chancellor of the Exchequer, and John Blunt. Their audacious proposal: consolidate a significant portion of this debt and offer it to a new private company. This company would, in return, be granted a monopoly on trade with the Spanish colonies in South America, the fabled South Seas. The South Sea Company, chartered by Parliament, was initially a clever financial instrument. Investors would exchange their government annuities for shares in the company, effectively converting a liquid debt into potentially lucrative equity. The promise of exclusive trade with the resource-rich Americas was the bait, suggesting boundless profits for shareholders. However, there was a critical flaw. England was still at war with Spain. The Treaty of Utrecht, signed in 1713, did grant Britain the Asiento the right to supply slaves to Spanish colonies and one annual trading ship. But this was a far cry from the free and open commerce the public imagined. The reality of the South Sea trade was meager at best. Despite this underlying weakness, the company's stock began to rise slowly, buoyed by patriotic fervor and the allure of distant riches. But the real frenzy wouldn't ignite until 1720. That year, the company proposed an even grander scheme: to take on almost the entirety of the national debt, some £31 million, in exchange for further concessions. This colossal undertaking required public confidence. The company embarked on an aggressive marketing campaign, spreading rumors of lucrative voyages and promising dividends that defied economic logic. Prominent figures, including members of Parliament and even the royal family, publicly endorsed the scheme, lending it an air of unimpeachable legitimacy. The stock price, which had hovered around £128 per share at the start of 1720, began its meteoric ascent. By March, it reached 300. By May, 500. The public, witnessing these seemingly effortless gains, abandoned caution. Everyone wanted a piece of the South Sea pie. It became less about the company's actual business and more about the ever-rising price. This was the true beginning of the bubble. People mortgaged their homes, sold their inheritances, and invested every last shilling. The belief was that the price would never stop rising, that there was always a greater fool willing to pay more. Logic and fundamental value were cast aside in the intoxicating rush of perceived easy money. The South Sea Mania spawned a host of imitators. Hundreds of new bubble companies sprang up overnight, promising everything from perpetual motion machines to importing large numbers of jackasses from Spain, or even famously, a company for carrying on an undertaking of great advantage, but nobody to know what it is. Parliament, initially complicit in the South Sea Company's rise, grew concerned by the proliferation of these fraudulent ventures. In June 1720, they passed the Bubble Act, explicitly forbidding the creation of companies without a royal charter. This was intended to curb the excesses, but ironically, it only served to channel more money into the already inflated South Sea Company, which possessed the coveted charter. By July, South Sea stock peaked at an astonishing £50 per share. Fortunes were made overnight, but they were paper fortunes, built on air. Savvy investors, sensing the inevitable, began to quietly sell off their holdings. The smart money saw the lack of fundamental value and understood that the music couldn't play forever. The subtle shift turned into a torrent. As more people tried to sell, the price began to waver. Then it started to fall. Slowly at first, then rapidly. Panicked investors, realizing their unimaginable wealth was evaporating, rushed to unload their shares. The market, which had rocketed upwards, now plunged into freefall. By September 1720, the South Sea stock had crashed below £200. Thousands of individuals, from humble servants to aristocratic families, found their life savings, their inheritances, and their futures utterly wiped out. The ripple effect devastated the economy, as banks that had lent money for stock purchases faced ruin. The shockwaves were immense. Prominent figures implicated in the scandal faced public outrage and parliamentary investigation. Directors of the South Sea Company were stripped of their assets, and some were even imprisoned. The nation demanded accountability for the colossal fraud and reckless speculation. Among the most famous victims was Sir Isaac Newton, who, after initially profiting, reinvested and lost a significant sum. He famously remarked, "I can calculate the motions of heavenly bodies, but not the madness of people." The government attempted to mitigate the disaster, establishing a sinking fund to gradually pay down the remaining national debt and redistribute some of the confiscated assets to victims. But the scars of the South Sea bubble ran deep, leaving a lasting distrust of speculative finance and joint stock companies. The South Sea bubble wasn't merely a financial event. It was a profound social and psychological phenomenon. It exposed the vulnerability of human judgment when confronted with the promise of quick riches, the power of collective delusion, and the dangers of unchecked financial innovation. Its legacy continues to inform our understanding of market bubbles. From tulip mania in 17th century Holland to the dot-com bubble of the late 20th century, the patterns of irrational exuberance, speculative fever, and eventual collapse echo the South Sea Company's tragic trajectory. The story serves as a stark reminder that true value is rarely found in the whirlwind of speculative hype. It's built on solid fundamentals, transparent operations, and a healthy skepticism towards promises that seem too good to be true. The South Sea bubble stands as a timeless cautionary tale, etched into the annals of financial history. Explore another historical financial meltdown and understand the timeless lessons of human greed.